Index funds are a popular and effective way to build wealth over time. These funds offer investors a low-cost way to invest in a diversified portfolio of stocks or bonds, which can help to minimize risk while maximizing returns. In this ultimate guide to building wealth through index funds, we'll cover everything you need to know about these funds, including their benefits, how they work, and how to invest in them. What are index funds? Index funds are a type of mutual fund or exchange-traded fund ETF that tracks a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Instead of actively managing a portfolio of stocks or bonds, index funds simply replicate the performance of the underlying index. This means that investors can achieve broad market exposure without having to pick individual stocks or pay high fees to fund managers. Benefits of index funds. There are many benefits to investing in index funds, including diversification. Because index funds invest in a wide range of stocks or bonds, they offer investors instant diversification. This means that you can spread your money across multiple companies, industries, and even countries, which can help to reduce your risk. Low fees. Index funds have lower fees than actively managed funds because they require less research and management. This means that more of your money is invested, rather than being eaten up by fees. Tax efficiency. Index funds are generally more tax efficient than actively managed funds because they have lower turnover. This means that they generate fewer capital gains, which can help to reduce your tax bill. Consistent returns. Because index funds simply replicate the performance of the underlying index, they tend to offer consistent returns over time. This means that you can expect steady growth over the long term. How index funds work. Index funds work by investing in the same stocks or bonds as the underlying index. For example, if you invest in an S&P 500 index fund, your money will be invested in the same 500 companies that make up the index. The fund will then track the performance of the S&P 500, which means that if the index goes up, your fund will go up, and if the index goes down, your fund will go down. Because index funds are passively managed, they require less research and management than actively managed funds. This means that they have lower fees, which can help to boost your returns over time. How to invest in index funds. Investing in index funds is easy, and there are several ways to do it. Here are the steps you need to follow. Choose a broker. You'll need to choose a broker that offers index funds. Look for a broker that has low fees and a wide selection of funds. Choose a fund. Once you've chosen a broker, you'll need to select an index fund to invest in. Look for a fund that tracks a broad market index, such as the S&P 500. Decide how much to invest. You'll need to decide how much money you want to invest in the fund. Consider your financial goals, risk tolerance, and investment timeline when making this decision. Open an account. Follow your broker's instructions to open an account and fund it with your chosen amount. Buy the fund. Once your account is set up and funded, you can buy the index fund. In conclusion, index funds are an excellent way to build wealth over the long term. By investing in a diversified portfolio of stocks or bonds, you can minimize risk while maximizing returns. And because index funds have low fees, they're an affordable option for investors of all levels. If you're looking to build wealth through index funds, follow these steps and enjoy the benefits of this popular investment vehicle.